I need to tell you something that I have not talked about publicly. Over the past several months, I have been quietly reducing my exposure to three sectors that I believe are heading for serious trouble. I am not making a big announcement. I am not going on television to sound the alarm. I am just methodically, systematically getting out. And by the time most investors realize what is happening, it will be too late. The damage will already be done. Now, I want to be clear about something. I am not predicting a market crash. I am not saying sell everything and go to cash. But I have been doing this for over 4 decades, and I have learned to recognize when the risk-reward in certain areas shifts from favorable to dangerous. When that happens, I do not argue with the market. I do not hope things will get better. I quietly reduce my exposure and move my capital to safer ground. That is what I am doing right now. And today, I am going to tell you exactly which 3 sectors I am exiting and why. Because if you are still heavily invested in these areas, you need to understand the risks you are taking. Let me start by telling you how I think about sector rotation, because this is fundamental to understanding why I make the moves I make. Most investors think about the market as one thing. The market is up, the market is down, but that is not how the market actually works. The market is made up of thousands of individual stocks across dozens of sectors. And at any given time, some sectors are doing well while others are struggling. Some sectors have favorable tailwinds while others face crushing headwinds. The key to successful investing is being in the right sectors at the right time. I learned this lesson early in my career in the late 1980s. I watched investors pile into savings and loan stocks because they were cheap. The price-to-earnings ratios were low. The dividend yields were high. It looked like a bargain. But the sector was facing structural problems that those valuation metrics did not capture. The business model was broken. Regulation was tightening. And one by one, those cheap stocks went to zero. That experience taught me that cheap is not the same as good. A sector can look attractive on traditional metrics while facing headwinds that will destroy value regardless of how cheap it appears. The smart money gets out before the destruction becomes obvious. The dumb money holds on, hoping for a turnaround that never comes. Right now, I see 3 sectors that remind me of those savings and loans. They look okay on the surface. Some of them even look cheap. But underneath, there are structural problems that I believe will lead to significant value destruction over the coming years. And I am getting out before that destruction accelerates. The first sector I am exiting is commercial real estate, specifically office and retail properties. Now, I know this is not a new concern. People have been worried about commercial real estate since the pandemic. But here is what most investors do not understand. We are still in the early innings of this crisis. The worst is yet to come, and the stocks and bonds in this sector are not pricing in how bad things are going to get. Let me explain what is happening. The pandemic fundamentally changed how we work before 2020. Most office workers went to an office 5 days a week. That was just how things were done. Then suddenly, everyone was working from home. Companies discovered that productivity did not collapse. Employees discovered they liked the flexibility. And now, 5 years later, we are not going back to the old model. Office utilization in major cities is still running at 60 to 70% of pre-pandemic levels. Think about what that means. 30 to 40% of office space that was being used before the pandemic is now sitting empty. That is not a temporary blip. That is a permanent structural change in how we use office space. Companies are not renewing their leases at the same square footage. They are downsizing. They are adopting hybrid work models where employees come in 2 or 3 days a week instead of 5. They are redesigning their offices with more collaboration space and fewer individual desks. All of this adds up to dramatically less demand for office space. What happens when demand falls by 30 or 40%? But supply remains the same. Vacancy rates spike, rents collapse, property values crater, and that is exactly what we are seeing. Office vacancy rates in major cities are at or near record highs. Class B and Class C buildings, the older buildings without the best amenities, are seeing vacancy rates of 40% or higher. Rents are down 20, 30, 40% from pre-pandemic levels in many markets, and property values have fallen by 50% or more in some cases. But here is what most people do not realize. Most of these properties have not yet been marked to market. The owners are in denial. They are holding properties on their books at values that do not reflect reality. They are extending loans rather than recognizing losses. They are hoping things will improve. This extend and pretend strategy works until it does not. And I believe we are approaching the point where it stops working. Over the next 2 years, over $1 trillion of commercial real estate debt is coming due. This debt was originated when interest rates were near zero and property values were at their peak. Now rates are 5% higher and property values are down 30 to 50%. When these loans mature, borrowers will have to refinance at higher rates on properties worth much less. Many will not be able to. They will default. They will hand back the keys. They will force lenders to recognize losses that have been building for years. This wave of distress will hit regional banks particularly hard. Many regional banks loaded up on commercial real estate loans during the good times. Those loans are now going bad. We already saw 3 regional bank failures in 2023 related, partly to commercial real estate exposure. I expect more failures in the coming years as the losses are recognized. I am exiting anything connected to office real estate, office REITs, regional banks with heavy commercial real estate exposure, bonds backed by office properties. I do not want any exposure to this sector. The losses are going to be severe, and I do not want to be anywhere near the blast zone. Retail real estate is a similar story, though not quite as severe. The shift to e-commerce has been crushing physical retail for over a decade. The pandemic accelerated that shift. And while there has been some stabilization, the long-term trend is clear. Physical retail footprints are shrinking, department stores are closing, malls are dying. The retail real estate that survives will be a fraction of what existed before. I have no exposure to retail real estate, and I am not adding any. The structural headwinds are too severe. Yes, some retail properties will survive and even thrive. But picking the winners from the losers is extremely difficult, and the downside for getting it wrong is severe. I would rather avoid the sector entirely. The second sector I am exiting is regional banking now. I want to be careful here because not all regional banks are the same. Some are well run with diversified loan books and strong capital positions. But as a sector, regional banking faces challenges that I believe will lead to underperformance for years to come, and I am reducing my exposure accordingly. The problems in regional banking go beyond commercial real estate, though that is certainly a major issue. Let me walk through the challenges. First, the interest rate environment has fundamentally changed. Regional banks make money primarily on the spread between what they pay for deposits and what they earn on loans. During the zero interest rate era, deposits were essentially free. Banks could gather deposits paying almost nothing and lend them out at 3 or 4%. That spread was pure profit. Now deposits are not free anymore. Savers have alternatives. They can earn 5% in a money market fund with essentially no risk. Why would they leave money in a checking account, earning nothing when they can earn 5% somewhere else? So banks have had to raise deposit rates to retain customers. That compresses their margins. At the same time, competition for deposits has intensified. The big banks, the JP Morgans and Bank of Americas, have scale advantages that regional banks cannot match. They can offer better technology, more branches, more services. When depositors get nervous, as they did during the 2023 bank failures, they move money to the big banks they perceive as safer. This deposit flight forces regional banks to pay even higher rates to retain deposits, further compressing margins. Second, loan demand is weakening. Higher interest rates mean less borrowing. Companies are not expanding as aggressively. Consumers are not taking on as much debt. Commercial real estate, which was a major source of loan growth for regional banks, is now a source of losses rather than profits. Without loan growth, regional banks cannot grow their way out of their problems. Third, regulatory pressure is increasing. After the bank failures in 2023, regulators are tightening standards for regional banks. Capital requirements are going up. Liquidity requirements are going up. Compliance costs are going up. All of this weighs on profitability. The banks might be safer, but they are also less profitable. Fourth, credit losses are rising. It is not just commercial real estate. Consumer credit quality is deteriorating. Credit card delinquencies are up. Auto loan delinquencies are up. Small business bankruptcies are rising. As the economy slows, these credit losses will accelerate. Regional banks with exposure to weaker borrowers will face significant provisions for loan losses. Put all of this together, and you have a sector facing multiple headwinds simultaneously. Margin compression from higher deposit costs, weak loan demand, rising regulatory burden, increasing credit losses. This is not a recipe for outperformance. Yes, regional bank stocks look cheap on traditional metrics. They trade at 8 or 9 times earnings. They trade below book value, but they look cheap before the 2023 failures too. And they got a lot cheaper. Cheap can always get cheaper when fundamentals are deteriorating. I have been steadily reducing my regional bank exposure over the past year. I am not completely out because there are some banks that are better positioned than others. But as a sector, I am underweight and getting more underweight. The risk-reward does not make sense to me. The third sector I am exiting is traditional media and entertainment. This one might surprise you because there are some great brands in this sector. Disney, Warner Brothers Discovery, Paramount, Fox. These are iconic companies with valuable content libraries and beloved franchises. But the economics of the media business have fundamentally changed, and I do not think these companies can adapt quickly enough to avoid significant value destruction. Let me explain what is happening. The traditional media business model was built on the cable bundle. Consumers subscribed to cable or satellite service and paid a monthly fee. That fee was divided among the content providers based on carriage agreements. ESPN might get $8 per SUB subscriber per month. TNT might get $2. The local sports network might get $5. Everyone got paid whether the subscriber watched their channel or not. This was an incredible business model, guaranteed revenue, predictable cash flows, high margins, and it worked for decades. But it is now collapsing. Cord cutting has accelerated dramatically. Millions of households have canceled their cable subscriptions. They are switching to streaming services that cost a fraction of what cable cost. They are buying antennas to get local channels for free. They are simply not watching traditional television anymore. Every cord cutter means lost revenue for the traditional media companies. And it is not just the subscriber fee. It is also the advertising revenue. Fewer viewers means less valuable ad inventory. Less valuable ad inventory means lower ad rates. The entire economic model is unraveling. The media companies have responded by launching their own streaming services. Disney Plus, Peacock Max, Paramount Plus, but streaming economics are very different from cable economics. In the cable world, you got paid for every subscriber whether they watched or not. In streaming, you have to convince people to subscribe to your specific service. You are competing directly against Netflix, Amazon Prime, Apple Television, and dozens of other options. And consumers are not going to subscribe to all of them. What we are seeing is streaming fatigue. Consumers subscribed to multiple services during the pandemic when they were stuck at home. Now they are rationalizing, they are keeping 1 or 2 services and canceling the rest. The streaming market is consolidating around the winners, and it is not clear that the traditional media companies will be among the winners. Meanwhile, the streaming services are losing money. Disney Plus has lost billions of dollars since launch. Peacock loses money. Max loses money. Paramount Plus loses money. These companies are spending enormous amounts on content to attract and retain subscribers, but they are not generating returns on that investment. The path to profitability is unclear. And as if that was not bad enough, the traditional businesses are declining faster than the streaming businesses are growing. ESPN is losing subscribers. The broadcast networks are losing viewers. The cable networks are losing relevance. These companies are trying to manage a transition where the legacy business is collapsing while the new business is not yet profitable. That is an incredibly difficult position to be in. I have seen this movie before. I watched newspapers go through the same transition. They had profitable print businesses that were declining. They tried to build digital businesses to replace the lost revenue. But the digital businesses never matched the profitability of print. The companies shrank, and many of them went bankrupt. I see traditional media heading down the same path. There might be winners in this transition. Netflix has proven that streaming can be a good business at scale. Amazon and Apple can subsidize streaming losses with their other businesses. But the traditional media companies, the ones trying to manage the transition from cable to streaming, are in a very difficult position. And their stock prices do not reflect how difficult that position is. I have been selling my media holdings. I sold Paramount before it was acquired at a fraction of its prior value. I have reduced Disney despite its great content assets. I have no exposure to Warner Brothers Discovery. The sector faces too many headwinds, and I do not want my capital trapped in a multi-year restructuring that may or may not work. Now, let me talk about what these three sectors have in common, because understanding the pattern helps you identify similar situations in the future. All three sectors are facing structural, not cyclical, challenges. This is the most important distinction. A cyclical challenge is when a business temporarily suffers because of recession or economic weakness, but bounces back when conditions improve. A structural challenge is when the fundamental economics of the business have permanently changed for the worse. Office real estate is not suffering because of a recession. It is suffering because the way we work has permanently changed. Even when the economy is booming, companies are not going back to 5 days a week in the office. The demand destruction is permanent. Regional banking is not just suffering from a bad credit cycle. It is facing structural compression of its business model as deposits become more expensive and competition from fintech and big banks intensifies. Even when credit losses normalize, the margin compression remains. Traditional media is not just going through a rough patch. The cable bundle that supported the entire industry is permanently unwinding. Even if the economy booms and advertising recovers, the structural decline in cable subscribers continues. When you are facing cyclical challenges, patience is often the right approach. Hold through the downturn and participate in the recovery. But when you are facing structural challenges, patience is the wrong approach. The business is not going to bounce back. It is going to keep deteriorating. The right approach is to get out and redeploy your capital into sectors with better dynamics. All three sectors also share the characteristic of extend and pretend. The problems are not yet fully reflected in reported financials or stock prices. Office landlords are not marking their properties to market. Regional banks are extending troubled loans rather than recognizing losses. Media companies are projecting streaming profitability that may never materialize. This extend and pretend creates an illusion that things are not as bad as they actually are. But extend and pretend always has an end date. Eventually, the loans mature. Eventually, the buildings sell. Eventually, the subscribers cancel. When reality can no longer be postponed, the losses are recognized all at once. Stock prices collapse. Investors who are holding on hoping for a turnaround get crushed. I do not want to be one of those investors. I would rather exit early, even if it means leaving some money on the table, than hold on and suffer catastrophic losses. When reality finally arrives, let me also talk about what I am doing with the capital I am pulling out of these sectors, because exiting is only half the strategy. The other half is redeploying into sectors with better risk-reward. The first place I am putting money is technology, specifically companies benefiting from artificial intelligence. This is the opposite of the sectors I am exiting. Instead of facing structural headwinds, technology is benefiting from structural tailwinds. The AI revolution is real. It is accelerating. And the companies at the forefront are going to generate enormous value creation over the coming decades. I am investing in semiconductor companies that make the chips powering AI. I am investing in cloud providers that offer the infrastructure for AI applications. I am investing in software companies that are integrating AI into their products. These are the businesses that will define the next decade of economic growth. The second place I am putting money is infrastructure. The United States is going through a massive infrastructure build-out: bridges, roads, airports, power grids, data centers, manufacturing facilities. All of this requires equipment, materials, and labor. Companies exposed to this infrastructure spending are seeing strong demand and growing backlogs. I am investing in industrial companies that sell into infrastructure projects. I am investing in equipment manufacturers. I am investing in materials companies. These are businesses with multi-year visibility on demand and pricing power in their markets. The third place I am putting money is healthcare. The population is aging. Healthcare spending continues to grow regardless of economic conditions, and innovation in areas like weight loss drugs, gene therapy, and cancer treatment is creating new growth opportunities. Healthcare is a sector with durable demand and structural growth. I am investing in pharmaceutical companies with strong pipelines. I am investing in medical device companies with leading market positions. I am investing in healthcare services companies that benefit from increased utilization. These are businesses that will grow regardless of what happens to the broader economy. The contrast between the sectors I am exiting and the sectors I am entering could not be more stark. I am exiting sectors with structural decline and entering sectors with structural growth. I am exiting sectors where extend and pretend is masking problems, and entering sectors where fundamentals are genuinely improving. I am moving capital from areas where the risk-reward is poor to areas where the risk-reward is favorable. This is how I think about portfolio management. It is not enough to find good companies. You have to find good companies in good sectors. A great company in a bad sector will struggle. An average company in a great sector can thrive. Sector selection matters as much as stock selection, maybe more. Let me close with a warning and some advice. The warning is that the damage in the three sectors I am exiting is going to get worse before it gets better. If you are heavily invested in office real estate, regional banks, or traditional media, you need to seriously consider reducing your exposure. The structural challenges these sectors face are not going away. The extend and pretend is going to end. And when it does, the losses will be severe. I am not saying sell everything tomorrow. Panic selling is rarely the right approach. But take a hard look at your portfolio. Identify your exposure to these sectors. Consider whether you are being compensated for the risks you are taking, and if the answer is no, start reducing your exposure in an orderly way. The advice is to follow the capital, watch what the smart money is doing. Not what they are saying on television, but what they are actually doing with their portfolios. If you see institutional investors reducing exposure to a sector, if you see insider selling accelerating, if you see lending standards tightening, those are warning signs. The smart money often knows what is coming before the rest of the market figures it out. I am not saying you should blindly follow what I do. You need to do your own analysis. You need to understand your own risk tolerance. You need to make decisions that are right for your situation. But when someone who has been doing this for over 4 decades starts quietly exiting certain sectors, it is worth asking why. It is worth considering whether you should do the same. The market is not one thing. It is a collection of thousands of stocks across dozens of sectors. Some of those sectors are poised to do well. Others are poised to struggle. The key to successful investing is being in the right sectors at the right time, right? Now, office real estate, regional banking, and traditional media are not the right sectors. The structural challenges are too severe. The extend and pretend is about to end. The losses are going to be significant. I am getting out. And I think you should think very carefully about whether you should too. Because when the damage finally becomes obvious, when the losses are finally recognized, when the stocks crater, it will be too late to act. The time to reduce exposure is before the crisis, not during it. The time is now. That is why I am quietly exiting these 3 sectors. Not with fanfare, not with dramatic announcements, just methodically, systematically, moving my capital to safer ground. Let me go deeper on each of these sectors because I want you to truly understand the magnitude of what is coming. On commercial real estate, let me give you some specific numbers that should concern you. The amount of office space sitting vacant in the United States right now is approximately 1 billion square feet. 1 billion, that is enough empty office space to fit the entire workforce of several major cities. And this vacancy is not evenly distributed. In some markets, in some building classes, vacancy rates exceed 50%. What happens to a building when half of it sits empty? The economics collapse. The landlord is still paying property taxes, still paying insurance, still paying for maintenance and security and basic upkeep. But the revenue has been cut in half. Most office buildings were financed assuming 90% occupancy. At 50% occupancy, the building cannot cover its debt service. The owner has to either inject more equity, negotiate with the lender, or default. Most owners do not have additional equity to inject. They bought these buildings with leverage precisely because they did not want to tie up that much capital. So they negotiate with the lender. The lender, often a regional bank, does not want to foreclose because they do not want to own a half-empty office building either. So they extend the loan, they modify the terms, they pretend everything is fine. This is where we are right now. Lenders and borrowers are in a state of mutual denial. But the denial has an expiration date. The loans have maturity dates. At some point, the can cannot be kicked any further down the road. And when that point arrives, there will be a wave of forced selling, distressed sales, and recognized losses that will shock investors who were not paying attention. I estimate that 20 to 30% of all office buildings in America will eventually change hands at distressed prices. That is not hyperbole. That is a realistic assessment based on the math of occupancy rates, rental rates, and debt levels. The owners who survive will be the ones with the strongest balance sheets and the best buildings. Everyone else will be wiped out. And it is not just the direct owners who will suffer. The lenders will suffer, the investors in CMBs, commercial mortgage-backed securities, will suffer. The pension funds and insurance companies who invested in commercial real estate for stable income will suffer. The ripple effects will spread throughout the financial system. This is why I have zero direct exposure to office real estate and minimal exposure to any institution with significant office real estate lending. The losses are coming. I do not want to be anywhere near them. On regional banking. Let me explain why I think the sector underperformance will persist for years, not quarters. The regional banking business model was built for a different era. It was built for an era when deposits were sticky, when customers had limited alternatives, when the big banks were not competing aggressively for every dollar. That era is over today. Every depositor has instant access to money market funds paying 5%. Every depositor can open an account at a big bank with better technology and more services in 15 minutes on their phone. Every depositor saw what happened to Silicon Valley Bank and First Republic and is wondering whether their regional bank could be next. This has permanently changed the cost of deposits for regional banks. They cannot go back to paying nothing on deposits. They cannot go back to the old model of gathering cheap funding and earning fat spreads. The genie is out of the bottle. Depositors have been educated. They know they have options, and they will exercise those options if regional banks try to underpay them. Some regional banks will adapt. They will find niches where they can compete effectively. They will build relationships with commercial customers who value local decision-making. They will manage their expenses ruthlessly and find ways to survive in a tougher environment. These banks might even thrive eventually. But as a sector, regional banking faces a prolonged period of adjustment. Margins will be lower than they were historically. Growth will be slower. Credit losses will be elevated as commercial real estate and other problem loans work through the system. Valuations will stay depressed because investors will demand higher returns to compensate for the increased risk. I would rather deploy my capital in sectors with tailwinds than fight against these headwinds. Maybe I am wrong. Maybe regional banks will stage a massive comeback. But I do not see the catalyst. I do not see what changes the fundamental dynamics. So I am staying underweight and using any rallies as opportunities to reduce exposure further. On traditional media, let me be even more specific about why I think the sector is uninvestable. The cable bundle was one of the greatest business models ever created. For decades, media companies received guaranteed payments from every cable subscriber regardless of whether that subscriber watched their channels. ESPN got paid even if you never watched sports. CNN got paid even if you never watched news. The Disney Channel got paid even if you had no children. This was an incredible arrangement for the content companies' guaranteed revenue. No need to convince consumers to specifically choose your product. Just be part of the bundle and the money flowed in. Media companies built their entire businesses around this model. They acquired sports rights expecting the bundle economics to persist forever. They produced expensive programming assuming the revenue stream was secure. But the bundle is dying. Every year, millions of households cut the cord. Every year, the pool of subscribers shrinks. And because the bundle economics depended on scale, the shrinkage accelerates the problems. When the pool shrinks, the cost per remaining subscriber goes up. Higher costs cause more people to cut the cord, which causes costs to rise again. It is a death spiral. The media companies saw this coming. They launched streaming services to replace the lost cable revenue. But streaming is a fundamentally different business. In streaming, you have to convince consumers to specifically choose your service. You are competing against Netflix, which has been perfecting streaming for 15 years. You are competing against Amazon, which can afford to lose money on streaming because they make it up on retail. You are competing against Apple, which treats streaming as a loss leader to sell devices. How does a traditional media company compete against that? They spend billions on content trying to attract subscribers, but the spending does not translate into profits. Disney Plus has over 100 million subscribers and has lost billions of dollars since launch. Peacock has tens of millions of subscribers and loses money. Max has gone through multiple restructurings and still struggles with profitability. The bears will tell you that streaming will eventually become profitable as the companies scale up and rationalize their content spending. And that might be true for some companies. Netflix is profitable. Amazon can probably make Prime Video profitable whenever they want. But the traditional media companies face a different problem. Their streaming businesses need to become profitable enough to offset the decline in their legacy businesses. And I do not see that happening. Linear television revenue is declining at mid-single-digit rates annually. Advertising is shifting to digital. Subscribers are disappearing. The legacy business that generated all the cash flow that funded the streaming investments is melting away. The companies are in a race to build streaming businesses fast enough to replace the declining legacy revenue. And most of them are losing that race. I have watched this dynamic play out before. I watched it with newspapers, which faced the same impossible transition from print to digital. I watched great newspaper franchises that had been profitable for a century, destroyed in a decade as digital classified and digital advertising gutted their business models. Most of them never found a digital model that worked. I see traditional media heading down the same path. Not all of them will fail. Some will find a way through. Disney has incredible content assets that could allow them to succeed in streaming. But the transition is going to be painful. The earnings are going to decline. The dividends are going to be cut. The stock prices are going to underperform. I would rather not be along for that ride. Let me also address the question of timing, because this is always the hardest part of getting out of troubled sectors. The sectors I am exiting have been underperforming for a while. Office REITs are down significantly from their highs. Regional bank stocks crashed in 2023 and have only partially recovered. Media stocks have been weak for years. So you might ask, is the damage already done? Am I exiting at the bottom? My answer is that I do not think the damage is done. I think we are still in the early to middle innings of these structural declines. The extend and pretend in commercial real estate has postponed the day of reckoning, but it has not prevented it. The regional banking problems are far from resolved. The traditional media transition is nowhere near complete. When I look at history, structural declines in industries typically take longer than people expect. The decline is not a straight line. There are bear market rallies. There are periods of hope when it looks like the sector might be turning around. Then the decline resumes. The investors who bought the dip get crushed. The investors who stayed out look smart. I would rather look smart. I would rather be early getting out than late. If these sectors stage miraculous recoveries, I will miss some upside. But I do not think miraculous recoveries are likely. I think the structural challenges are real and persistent. I think the next several years will see more pain in these sectors, not less. Let me share one more piece of advice about how to think about exiting troubled sectors. Do not fall in love with your investments. Do not hold on to a stock because you used to make money on it, or because it used to be a great company, or because you have owned it for years. The market does not care about your history with a stock. The market only cares about future cash flows. If the future cash flows are impaired, the stock will go down regardless of how much you love it. I have made this mistake myself. I have held on to positions longer than I should have because I liked the company, because I had conviction in the management team, because I could not accept that the thesis had changed every time. I regretted it every time. I would have been better off cutting the position and moving on. The best investors I know are ruthless about cutting losers. They do not let emotion cloud their judgment. They analyze the fundamentals. If the fundamentals have deteriorated, they sell. They do not hope for a recovery. They do not pray for a turnaround. They accept reality and move on. That is what I am doing with these three sectors. I am accepting reality. The fundamentals have deteriorated. The structural challenges are severe. The risk-reward is unfavorable. So I am exiting. Not because I enjoy selling. Not because I want to be right about the decline. Simply because it is the rational thing to do given the facts as I see them. You should apply the same discipline to your own portfolio. Look at your holdings. Ask yourself whether the fundamentals support your position. Ask yourself whether you are holding on out of hope rather than analysis. If you are, consider whether it is time to exit. The market is not going to bail you out of bad positions. The market does not care that you need the stock to go up. The market does not care about your feelings. The market just reflects the collective assessment of future cash flows. If those cash flows are impaired, prices will fall regardless of what you want to happen. That is the harsh reality of investing. And that is why I am quietly exiting these three sectors before the harsh reality becomes even harsher. Consider doing the same. Your portfolio will thank you.